Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on October 18th, 2022. We have a trading session not this Tuesday, but the next Tuesday. We're here in Las Vegas with the Millionaires Trading Club, but we will be trading via alert, new positions, managing positions, closing positions. And today I want to talk about trading earnings and how we do it in a conservative way to generate cash and to generate income. Quiet week last week. Obvious reasons, earnings coming out, CPI coming out, but we still had quite a successful trade. As you can see, there was only one closed trade. But if you go forward, you can take a look. We were quite busy in terms of generating cash through our roles, through the constant management of core positions. But there are times not to trade. It was a discussion that's actually started today here in Las Vegas about when you think about a trade, it seems to be a binary. Do I make the trade or not? Well, there's three choices about trading, which is make the trade, not make the trade, or this is not the time to trade for me personally. And that's why we took it a little bit light with the CPI coming out. We saw amazing reaction up, then an amazing reaction on Friday down, and so forth and so on. But we're going to pick up the pace a little bit as earnings season is upon us with the big banks. Starting on Friday, we have Bank of America today and so forth and so on. So last week to goal, we were just a smidge under because, as I said, a little bit of a quiet week for obvious reasons. But you can see those rates of return are up there. They're where we want them to be or even higher than what our minimums are. And this is going to be, I hope, significantly better because we're going to be more aggressive because earnings season creates an enormous number of opportunities in the way we trade them because of volatility associated with a company and its stock when earnings announcements come out. Now, last week, following that hot CPI report, the market tanked, then popped, then fell again. And this seems to be a result of something that, again, forgive me for name dropping, that we're here is a constant topic among some of us who've been around, which is that the last real bear market, real one, meaning not an 18-month correction that we popped, a geopolitical downturn for 3 months or 3 weeks, but a bear. The last bear market was when the end of the Nifty 50 ended with inflation around 72, and then the bear market ended in 81. Bear market coincided with inflation going up and interest rates going up. Well, what do we have now? And there are very few people on Wall Street who've experienced a bear market, a real one. And we didn't have algorithmic trading back then. We didn't have the volume that we had. We didn't have the cross-linking. We had an American stock exchange. We had options exchanges on the Pacific Coast and so forth and so on. So it was a very different world, and the lack of collective experience is one of the reasons we can't get a consensus on what's going on in the market. You combine that with robotic trading, you get this serious, radical ups and downs in a very short period of times. Now, the big banks did surprise the street, not us here. Higher interest rates, for example, at JP Morgan, are kicking in and creating significant revenue and therefore spread and therefore profit increases for the big banks. And there were mixed earnings because the banks are also exposed to investment banking, which plunged, mortgage refinancings, which plunged, and so forth and so on. And another thing to keep in mind is consumers' spending was flat in September, and it's a reaction to inflation, and I think concerns about a recession. They're continuing, though, to increase the percentage of money that they're dedicating, if you want to call it that, towards services, and that was shown both in Delta Airlines earnings, but also the comments by management in the earnings call. You can look at the transcript online, and they were talking about that they'll be back to pre-pandemic capacity levels probably by next summer. I'm glad we gave the industry $55 billion to keep everybody employed in a capacity. Fine. Yeah, sure. I'm sorry for the sarcasm, but that's a lot of money to be able to savage services the way they did and create the problems that they have for consumers. But they'll plow on, and they were speaking, Delta was at least speaking quite well of what they were viewing for next year. And that was an earnings announcement that we traded. I'll break down the trade in a moment. But in Options Income Blueprint, we don't speculate, okay? We're not going to buy a call or put ahead of an announcement. We're going to sell after. We trade after the announcement comes out. And that's to Trade on real news. Trade on market reaction. It may not be 5 minutes after the announcement, maybe the next day. It probably is going to be the next day. And we build positions based on fundamentals, and the fundamentals can change, from my view, based on what comes out in the earnings announcement. It rarely happens, but it can. And if you correctly guess, and I have an experience with this a long time ago, 30 years ago, I nailed Intel's earnings, and I had a speculative position at the time, not in a service. I was in the computer business at the time. And I had a call position. It was not a small one. It wasn't gigantic, but it wasn't small. It wasn't one contract. And I nailed their earnings, and I heard it on the radio, and I was really happy, and the stock sold off. So, and I lost all the money on the trade. And the point is, you can't necessarily gauge what Wall Street is thinking, even from headlines, or especially from headlines. But if you wait until earnings come out, you have a much better sense of what's going on in the real world, what's going on with the company, and market reaction. Is there a short squeeze? Is there a run-up that may abate when it hits a certain level, and so forth and so on? And most importantly for us, since we're selling mostly puts, volatility, and therefore premium, doesn't go away after the announcement. Maybe a little bit of it does, but not a lot. And a lot of the premium that builds up in the option chains before earnings come out are there when earnings have come out. So Delta reported Q3 earnings on October 13th, Thursday, before the open. Record revenue, better than expected net income and adjusted earnings per share, including, I was surprised, upbeat forecast. That's the most important thing for the market. And as I said, they expect to restore capacity to pre-pandemic levels, which is the real indication of confidence in where the consumer demand is going. And you can see how the stock traded. This is a chart that highlights the movements don't seem that big, but they actually are in that price stock. It's a 6 to 7% move. And it's the kind of thing you can trade because, as you can see down here, volume is still there. This is Friday morning. It's still there. And the bottom line is we put out a trade. Stock was at 31.31. It's 29.50 put. And that's a very hefty rate of return. That's a more than 1% rate of return in basically 8 calendar days and 6 trading days. And that's how you capture that volatility. You're capturing the volatility that built up before, and now you're reaping the harvest of other people's speculation. You're taking their cash and you're putting it in your pocket. Now, there's a zillion earnings announcements coming out in the next 4 weeks. And this week, again, will be bank earnings. And what we really need to be looking at is the Q4 and 2023 revenue forecast, not profit forecast. The street is concerned with growth. They're not concerned as much with profit margins because inflation has distorted things, historical metrics. They're concerned about, is the recession hitting your company? Do you think the recession will hit your company? Do you think there will be a recession? And so forth and so on. Aside from that, from the individual stock announcements, the market is wrestling, regardless of where it may be as you're listening to this, at 3,500 on the S&P. News prompts trading. It takes on a life of its own, as we saw in the Thursday-Friday response to the CPI numbers. We're going to continue to do what we're doing, generate cash on those core positions, just keep it pouring in every single week, and then we're going to selectively trade safe haven stock like Bristol-Myers, a fossil fuel stock, depending upon what's going on in the world with Devon, a beaten down stock, which has come back to life, Lennar, or things like Roku, Starbucks, and Square. You can see these cut across. You're talking about pharmaceuticals, fossil fuels, housing, advertising/media, coffee/consumer spending, and payment processing. These are all that we'll trade anecdotally as opposed to month after month, week after week. Although Starbucks, I would probably do that. In 2023, you'll see a lot of Starbucks trades. And again, let me conclude by saying we will be trading via alert this week as opposed to live. And I'll see you again on the 25th. This is Michael Schulman for Options Income Blueprint.